What's going on, ladies and gentlemen? Welcome back to another video. Thank you guys once again for tuning in. So back when I was 18 years old, that was the day when my father told me the power of investing and what it truly means to get invested within the market and what it can do for you over the course of your life. And that was the day that he sat down and taught me the rule of 72, which is a compound interest rule that can help you determine how much money you might have when you actually retire, or a good estimated amount of money you could expect to have by the time you retire. And it was that day that I always stuck to investing and knew that it was very important, no matter what the circumstance, to always make sure that you're at least putting some money away for savings or for retirement, so that way when you are ready to retire, you aren't poor. So if you don't want to end up completely dirt poor, then definitely follow along in this video. So today we're going to be discussing an ETF. An ETF stands for Exchange Traded Fund. Now these are very common amongst the investing world, and many of you guys yourselves have already invested in these ETFs or probably traded them at some point in your life. So why are we talking about these particularly? So for most investors, when it comes to the market, everybody wants to be relatively diversified so they don't have too much money located in one specific security or one specific stock, because most investors have a tough time stomaching the big wild swings in the market. So if anybody's ever invested too heavily into one particular asset or one particular class of securities, then of course you might end up losing too much money. Since none of you guys want to end up poor, like the person who bought Bitcoin at 20,000, then stay tuned. So an exchange traded fund is what we're talking about today. An exchange traded fund can be classified as ETF. So what are these? So generally an ETF is similar to a stock, but the big difference between an ETF and a stock is an ETF is comprised of many different stocks. See, for example, you can take the S&P 500. The S&P 500 is an index that tracks or is like a measurement of all 500 companies in the stock market at any given time. An ETF is something that is comprised of all of the different stocks within the stock market or the S&P 500. So let's take a second and think here. If you wanted to buy the S&P 500 index, you're not allowed to. You just can't do it. The only way you could actually own the S&P 500 index is if you were to go out and individually purchase one share of every single stock that makes up the S&P 500. And just so you know, the S&P 500 is the top 500 biggest market cap stocks within the stock market. SPY isn't the only ETF you can buy. See, there's many other ETFs in the market. Heck, there's hundreds of different ETFs in the market that you could actually buy. So for example, you have the Dow Jones. The Dow Jones is going to be your top 30 companies. You have stuff like the IWM, which is going to be the Russell 2000. And you have things like the S&P 500 again, which is the top 500 companies. You also have ETFs that can be solely focused on one specific sector within the stock market. So you could be thinking about wanting to get into the real estate market through investing. You could do this by buying an ETF-related real estate ETF. So it's not only an S&P 500 ETF, or it's not only a Dow Jones ETF that you can buy. There's hundreds of different ETFs you can buy that might be catered better to your investing approach to the market. So now that you've decided that you don't want to be poor and you've come to the conclusion that investing for the long term is probably a good approach to having a good nest egg, well, let's think about it. Why would you want to buy an ETF, or why would you want to invest in an ETF maybe over just one particular stock? See, ETFs provide a means of diversification. As we mentioned before, an ETF is usually comprised of many different stocks and companies, and that in itself provides a good amount of diversification. See, for example, I could go out right now and I could buy shares of Amazon. But if shares of Amazon go up or go down, then I'm either going to be winning or losing money. But if I were willing to buy an ETF that might contain Amazon, Facebook, Google, Nvidia, Coca-Cola, etc., many different companies, then if Amazon goes up one day and then Facebook goes down the next, then I'm kind of covered because I own some businesses in this ETF that are going up on this day, and of course I own some businesses in this ETF that are going down, and that right there is what gives you the diversification. So part of the reason you want to own an ETF is A, for diversification. The next big one is volatility. See, with ETFs, they're seen as less volatile because they're comprised of many different companies. And as we had mentioned before, if you were just to buy a few shares of Amazon and it goes up or goes down, you were solely stuck to Amazon and the price action in which that moves. But if you own an ETF, the ETF is comprised of so many different companies, then a lot of times it can also provide a little bit of security against very volatile moves within the market. And as you know, investors don't like necessarily big moves to the downside because it creates a scare, it creates fear, and it might pressure someone into actually selling. So a lot of times investors over the long run like to stay diversified. Now, something you have to think about is if you're going for a long haul investing game through diversification, then you should be with the understanding that you're not going to make as big of a return, because the more diversified you are, then the less exposure you have. And with the less exposure you have, the less chance you are to making really significant gains, but it is also a way to protect yourself against significant losses. So you got to ask yourself, over the long run, you can make a lot of money through saving and investing, but you don't want to lose too much. So again, ETFs could be a great option for many investors so that way they're diversified and they're kind of hedging a little bit against some market volatility. Another big key talking point about why ETFs are good is because a lot of people actually like to trade ETFs. So whether or not you're looking to invest for the long haul or you're actually just looking to trade, ETFs provide a good way for traders to get involved in the market, because ETFs are very similar to stocks. See, when you buy a stock, you can go and simply buy it and sell it. Very similar to an ETF. See, like a mutual fund, people don't actually trade mutual funds. They tend to just invest in mutual funds. And ETFs provide some type of format in which it's like a long-term investing mutual fund, but it's not, because you can actively buy and sell an ETF similar or the same as you could a stock. And ETFs tend to have very high liquidity. So if I or you would like to buy one of these ETFs, it's very simple for us to go and put in a market order. See, with ETFs, you can put in market orders, you can put in limit orders, you can actively buy and sell ETFs as if they were just stocks. One more important thing that you got to understand about ETFs is that all ETFs have an expense ratio. Because you got to think, in order for an ETF to be comprised of many different companies and many different stocks, it doesn't just happen out of thin air. Somebody has to be actively managing the ETF to make sure it's working properly, and this can be involved in the buying and selling of many different shares within that ETF, and that in itself costs money. So there's management fees, there might be transaction fees, and that is what's getting calculated into your expense ratio or your expense percentage of whatever ETF you're owning. And it's very simple to find out what your expense ratio is simply by going to Google and searching in whatever ETF is you're planning on buying and looking up what is the expense ratio for the SPY ETF that it is that I'm thinking of buying. Now that we've all come to the conclusion that you're going to be a multi-billionaire after watching this video, please do give the video a thumbs up. But now we have to touch on the cons of ETFs. The cons of ETFs really aren't big. There's more pros than there are cons. There's more good than there is bad. See, the cons to ETFs aren't pretty much anything. They're almost the exact same as the pros. See, many people out there think that ETFs have a wide variety of diversification, while others think that ETFs don't have a wide variety of diversification. So again, it's kind of a catch-22. They do provide a good amount of diversification, and then others are going to argue that they don't have a wide variety of diversification. Really, the last con that we can possibly think about when it comes to ETFs isn't really big. It's kind of just thrown in there, and that's commissions and fees. See, when it comes to an ETF, as we mentioned before, You could simply trade an ETF just like it's a stock. So if you simply trade an ETF like it's a stock, then you're going to pay a commission for pretty much every time you make a transaction, unless you're buying one of those ETFs that don't charge commissions, and then of course you're not paying a commission, but again, that's for another time and another story. But as of right now, generally when you go to buy an ETF, you're going to pay some sort of commission, and as we already talked about, you're going to pay that expense ratio pretty much every single day over the course of 365 days. So again, there is a little bit of drawback when it comes to ETFs, but as we mentioned before, the pros outweigh the cons any single day of the week. And really, if you want to make a decent amount of money over the course of your lifetime, then the goal is always to start investing as young as possible and investing as much as you possibly can without really putting a strain on your financial life and with your relationship and your personal life. So as long as you can put away a decent amount of money without affecting your relationship, without affecting your personal life, and without really putting, a damper on your personal finance, then you should be doing that. The longer you're invested with, the more amount of money just generates a bigger amount of return, which just means you can take more vacations and you can drink more booze on the beach with beautiful looking women next to a yacht while you're driving a Ferrari. With that being said, ladies and gentlemen, hopefully you guys have learned something new today and have inspired some of you guys to maybe take the additional steps to securing a financial future for yourself by not buying Bitcoin at $20,000 and possibly by following the traditional route of long-term investing in compound interest. With that being said, thank you guys once again for tuning in. As always, make sure to hit the notification bell and subscribe button so you don't miss the next video we post. Thank you guys once again. Boom.